Hey, this is Stu with the Military Investor Network, and I'm going to go through a single-family rental property rehab project that we are starting. We have this property currently under contract, and we're closing on it next week, and we'll start a rehab on it right away, and turn it into a rental property that we'll sell to someone within our network, another military investor. We are buying it through our other company called Storehouse 310 Ventures, and this is a 3-bed, 1-bath, about 1,200 square feet with an attached garage in Milwaukee, Wisconsin. We really like the property and excited about it. Just to kind of go through some pictures real fast on Realtor.com. This is obviously pre-rehab of how it looks right now, but it's a real cool little house in a nice little neighborhood in central Milwaukee. So we're going to be going through this house and doing a full update on everything, making sure all the new major components of the house are updated, and doing all the cosmetic work, making sure everything is up to par with and up to code. It's an older house, so we'll make sure everything is looking good there. It's a real good looking bathroom there, pretty nasty. But we'll go in, do all the major components, and get it ready for a tenant. We'll turn it over to property management, and they'll find a tenant and get it rented, and then we will then sell it to another investor who wants cash flowing rental property. Here's kind of a breakdown. We use the Bigger Pockets rental analysis to run our numbers. And our ultimate goal is to sell it at a minimum of a 10% cash-on-cash return to the investor in year one. And also another goal of ours is to at least have $200 of monthly cash flow after all expenses. And we'll go through some of those expenses in a minute. But this house will be selling for $105,000. And put an estimated purchase closing costs for the buyer, and it's worth about $110,000. Doing the market comparable analysis, running the comparables of what's sold in the area, and also comparing it to some of the other properties that we've done that we've had appraisals on in the same area. So 1,234 square feet, 3-bed, 1-bath. It was built in 1940. And as you see here, it rents for around $11.95 a month, and that is kind of the middle of the road average rent for the area for this size of a property. Hopefully we could get more, but we stay conservative on these numbers. So let's look down here, what it will cost. So $21,000 down payment. This is a 20% down loan on a conventional 30-year financing. So you'll have a loan amount of $84,000, and we did a 30-year estimation loan at 5.75% interest. So your monthly principal and interest payment for this property will be $409.20. And then let's go down here to the expenses on how we calculate it. We said that the income is $11.95 a month, and we try to stay really conservative with our numbers as far as expenses go. Hopefully, the property performs better than this, and you have a higher cash flow. But this is kind of setting a standard expectation, and if we beat it, then even better. So we put 7% in for vacancy. We put 5% in for CapEx savings, because down the road you're going to have something that breaks, and you'll want to have that savings built up to where you can pay that. Management, we have property management in place for 9% of the rent. Property taxes, that's based off of this year's property tax assessment. Repairs, we always put in 5% for repairs and maintenance. And then insurance, this is an actual quote that we get from our insurance company. And then obviously the principal and interest payment of $490 a month at 5.75% interest. So your total here is $989 out of pocket that you're spending each month for those planned expenses. and then you have your 1195, which gives you that cash flow of $205 a month, and the 10.22% cash on cash return. If you go down to the next page here, this kind of goes over some more numbers here. You're paying down this initial equity, gross rent multiplier. Another rule we try to really look for is the we go off of the 1% rule, so we're at 1.1%. And cap rates in the area are standard of about 7%. And then if you go off of this cap rate, the ARV would be a little higher. And then another number we look at is the debt to coverage ratio. We like it anything above a 1.2 for that. This is another way to calculate using the 50% rule. Just kind of that kind of guesstimate there. And then if you do an analysis over time, we made an assumptions that your expenses are going to only increase by about 1% a year, and your income and your property values kind of standard 3% a year, and that's using long-term real estate projections of how markets have gone for hundreds of years. So if you look at the cash on cash return over time, it obviously just gets better and better as you increase income and value, and your expenses hopefully can stay the same, or if it any goes up just a little bit. So we think this is a really great property, really great asset to buy for long-term passive income. And we have a lot more of these that are very, very similar, and just wanted to give an example of one of the properties that we're working on right now. Hopefully this helped see how we calculate things, and if anybody has any questions, please reach out to me. We'll have more of these coming down the road, and if you're interested in buying some cash flowing rental property in what we think is a really good market, then let us know. Please share the video, like the video, go to militaryinvestornetwork.com, become a member if you're a military or veteran, and please spread the word about our network.